Hello, my name is Maria Bezubova and you're at my channel Fertilizers Jazz. Here we talk about events, trends, technologies in the world of fertilizers and agriculture. Please subscribe to the channel, put like to this video, and that's jazz. Today is September 22 and this is a weekly markets update. Let's have a look at the news of week 38 and see what are the next trends. Today and tomorrow I am attending Argus Fertilizers Caspian, Black Sea and Eastern Europe conference in beautiful Istanbul. So, if you're here as well, don't hesitate to ping me. For others who will not attend, I will make a short summary in the next weekly to summarize discussions and general mood of the market. Urea price trend and sentiment was generally bearish, but different depending on the region. Indian tender finalization on the bearish note left several Middle East producers with significant volume on hand. And this was the key reason for very low offers level in the Ethiopian tender that closed last week. Fertiglobe was leading in terms of volume offered at L1 at $419 FOB for Egyptian and UAE tons for loading through October-November. At the same time, ETG made a very aggressive offer for November through February shipment at $410 FOB Qatar. At the same time, Egyptian producers felt quite confident after selling out a considerable amount a week ago. So last week, their offers levels surged to 440 and above. NCIC even secured sales of 10,000 tons at $452 FOB level to Europe. But this is clearly not the market average and definitely too far from existing base level. European buyers felt the momentum to replenish some stocks a week ago, but now the momentum is gone. They will wait for further price drop. A sale of Turkmen cargo was registered in the Black Sea at $395 FOB level, which kind of demonstrates general interest level. Iranian producers dropped prices more to the range of $365 to $70 FOB, but still the sales are not very active. Taking into account general market sentiment, buyers expect Iranian level to be even lower. Indonesian sales tender result confirmed the overall mood. Pupuk Kaltim sold 2 cargoes of 45,000 tons each at $412 FOB, failing to achieve its target of $430. In fact, 3 weeks ago, a producer received offers at $455 and rejected them, perhaps waiting for more upside, which didn't happen. In the US, liquidity was absent and prices inched lower to $390 to $400 per short ton FOB range. Also, market was quiet because most of the industry players were attending TFI conference in Chicago. During the week, there were discussions around potential US sanctions at Russia that would also hit fertilizers market. But personally, I don't believe it will happen. I think the base scenario we should count on is that Russian tons will happily go to the US market in the next season. In Brazil, the CFR range widened last week to $425 to $40, depending on the origin. However, demand remains subdued because of affordability issues. So now all eyes will be on India again, as the new tender is awaited. However, due to significant amount of product that needs to enter country's ports in upcoming month, it is unlikely that the tender will come sooner than first half of October. As usually, tender timing will be for price trend in the market. Ammonium sulfate prices continued their downward correction last week due to slow demand and bearish sentiment in the urea market. Chinese FOB copper price decreased to $135 to $40 range and granular slipped to $150 to $55. Several buyers in East Asia are testing the market for October shipments, specifically for 10,000 tons to Indonesia, about 10,000 tons or more to Philippines, but no firm deals were conducted last week as the prices are falling. Also last week, 20,000 tons of Capron Sul were sold into India, around $160 CFR for October shipment. In Brazil, granular CFR price was assessed in the range between $160 to $70, and more than 50,000 tons of product changed hands in this range last week. Buyers' bids are on the low end of this range. and such aggressive level limits trading activity. In the nitrates market, European demand starts to wake up, but only on the trading side, while farmers' offtake is still dead. Some discussions for CIN in German and French markets has restarted, but sentiment is extremely bearish for now. At the same time, African demand is quite active. About 30,000 tons of ammonium nitrate of Russian origin was sold to Morocco at the level of $330 CFR. This volume is for shipment through Q4. UAN demand is mostly subdued across the globe. In the ammonia market, prices pushed higher due to limited supply options, especially for prompt shipments. In Europe, the market is awaiting fresh sales from Sorfert that will have significant amount of product for October, but it targets at least $550 FOB. This will bring CFR price back to the level of $600. Let's see how much demand this level will provide, as with current TTF price for natural gas, ammonia cost-based production will be at premium. Further to the west, in the US, rumors put October contract price at Tampa at the same or slightly higher level versus September. Spot export activity was low, with prices unchanged. In Trinidad, previous fears about gas supply cuts in September are not discussed anymore. However, it might happen late October or November. For now, production is steady at more than 80% capacity and prices remained unchanged last week, at the level of $500 FOB. East of Suez, FOB prices increased more by $5, supported by healthy demand from India and shrank supply. In the East Asia, prices increased even more by $10 amid limited prompt supply options. Activity in phosphate segment was rather slow last week. Ethiopia and Bangladesh have active tenders that were supposed to close last week. However, in Bangladesh, the tender was blocked by the High Court, so the new one is expected soon. Ethiopian ABC received offers in its DAP tender from 9 suppliers with product from China, Jordan, Russia, and Egypt. The Alwad was Fertistream with supply from Russia at $780 FOB for 2 lots. European demand remains subdued because of high prices. There are fears in the market of further demand destruction amid extremely low affordability. Still, OCP reported sales of 11,000 tons of DAP last week to the Western European markets at the levels similar to previous sales, $805 to $20 FOB range. No new DAP business was heard in India last week, but sentiment remained bearish. There are rumors that offers are already below $800 CFR level, may be linked to the tender of GSFC, however, no details are available for now. DAP prices in China inched lower to the level $770 to $80 FOB, but Chinese producers aren't under pressure to sell due to limited cargo availability and most export quotas being used. Southeast Asian buyers were watching the market closely, debating whether to buy now or wait, as there's some pent-up demand. For Southeast Asia, freight adds $20 to $25, putting CFR levels around $805 for destinations like Thailand and Vietnam. Another company-related news came from Jordan, where GPMC signed a 10-year strategic supply agreement with India's Coromandel. Starting April 26, GPMC will supply 500,000 tons of phosphate annually, alongside 250,000 tons of phosphoric acid annually, with volumes increasing to 300,000 tons by the end of 2027. MAP CFR price in Brazil dropped more to the level $710 to $15. However, there was no actual trading activity amid continuous low domestic offtake. US market was very quiet with no moves last week. Moving to the fundamentals. European natural gas futures slipped toward 32 euros per megawatt hour, supported by abundant LNG inflows and mild windy weather that curbed demand. EU storage now stands at over 80% of capacity. Still, Germany's Emden gas terminal will begin planned maintenance on Thursday, which could temporarily tighten supply. Meanwhile, geopolitical risks remain an upside factor. Russia's sanctioned Arctic LNG-2 project continues to deliver cargoes to China, indirectly pressuring global prices, while US President Trump warned that new sanctions on Russian energy could be imposed if NATO allies also halt imports and adopt similar restrictions. US natural gas futures dropped toward $2.9 per MMBtu due to abundant gas in storage and forecasts for milder weather, reducing near-term demand. Record production earlier this year allowed higher than usual storage injections, with inventories about 6% above normal. On Thursday, the AEI reported a record build for the week ending September 12, surpassing the 5-year average by more than 20%, as mild temperatures limited heating and cooling demand. Looking ahead, forecasts indicate warmer than normal weather through October 4. Agricultural commodities future prices were all in red. Wheat futures slipped toward $5.22 per bushel, extending a two-day retreat from a 1.5-month high reached on Thursday, as traders weighed domestic and global supply prospects. Forecasted showers across the Midwest and North Delta are expected to benefit U.S. soft wheat crops, while Western Australia raised its output outlook by 300,000 tons. Adding to the bearish tone, the International Grains Council boosted its 25-26 global production forecast by 8 million metric tons. These supply-side increases have pressured sentiment, though U.S. wheat has pared some of its earlier losses this week. Overall, futures remain steady but face ongoing headwinds from abundant global production and improving crop conditions. Corn futures also dropped at the end of the week, driven by a mood of uncertainty regarding the future crop size. Any hope for a late-year rally will likely have to be driven by expectations for U.S. production to be lowered several hundred million bushels, which could happen. It did last year. U.S. exports remain strong and competitive internationally, aided by a softer dollar and stronger Brazilian real. Argentine corn planting forecast is steady, while plantings advanced to 6.2% complete. With wheat and barley harvest completed in Ukraine, the attention shifts to corn, which is 2% harvested. Interestingly, China has approved another 96 genetically modified corn varieties as they seek to become more self-sufficient in supply. Soybean futures fell again toward $10.25 per bushel, pressured by lingering uncertainty over US-China trade talks. Traders had anticipated that the meeting between President Trump and President Xi might trigger new Chinese purchases, but the lack of concrete developments led to earlier week declines. The market had been anticipating a major sale or a framework agreement to lift the freeze on soybean shipments between the two countries. Large global supplies and weak Chinese demand continue to weigh on prices, even as harvest pressures mount. Analysts caution that while short-term support may surface, ongoing U.S. harvest progress and expectations for a bumper global corn crop could push soybeans lower. Moving to the shipping industry. World Container Index by Drewry Consultants dropped more by 6% versus a week ago. After 2 weeks of moving in opposite directions, the major trade routes, Trans-Pacific and Asia-Europe, are now aligned in a downwards trajectory, although each is moving at a different pace. Trans-Pacific spot rates have started declining again, and despite a brief uptick, the momentum from general rates increases and blank sailings has now faded, which led to the reduction in rates. On Asia-Europe routes, decline comes as a carrier struggle to match increased capacity due to new vessels entering the trade with softening demand. As blank sailings increase ahead of China's Golden Week holidays, which begins on the 1st of October, Drewry expects rates continue to decline in the upcoming weeks. The Baltic Exchange Dry Index increased last week. The Capesize market experienced a week of mixed activity, highlighted by a strengthening Pacific, South Brazil and West Africa to China routes, while the North Atlantic market struggled. For the Panamax market, it was a cautiously optimistic week, as period demand crept into the market, with Atlantic routes the most prominent risers. This was largely led by solid mineral and grain demand, especially from the US Gulf, while in Asia, numerous holidays impacted trading. In ultra-supramax segment, the Atlantic was varied, with US Gulf being fairly firm at the beginning of the week, but towards the end it had eased. The South Atlantic lacked fresh impetus, and the continent Mediterranean were described as positional. Same mixed performance was obvious in Handysize segment, as activity picked up in the US Gulf. However, owners with vessels open in the South Atlantic continued to face limited options. In Asia, the market remained generally balanced. To sum up, bearish sentiment in the urea market persists for now. Middle Eastern tons that were not accepted in the last Indian tender were placed in the Ethiopian tender at unexpectedly low price. Indonesian sales tender was also finalized at a very low price compared to offers of last week's. Only Egyptian producers tried to maintain and even increase price level during the week. However, this level was not attractive to European and other nearby markets. So, most likely, we will see trading activity frozen for some time. The timing of the next Indian tender is crucial for market sentiment in October. If rumors are true and the tender is announced somewhere first decade of October, perhaps general price level will not deteriorate too much. But if not, then significant downward correction is inevitable amid low affordability and thus subdued demand. Ammonium sulfate price was again under pressure amid developments in urea segment. Nitrates demand started to pick up in some European markets, but under current market circumstances will not result in any significant sales in close future. Ammonia price continued to firm both sides of Suez amid supply limitations, especially for prompt shipments. In phosphate segment, price deterioration continued, but demand that is concentrated in India, Ethiopia, and Bangladesh for now is strong to support the level from significant sliding. Natural gas price, both in Europe and US, decreased amid healthy production and warmer than expected weather conditions. Future price for all crops dropped slightly due to uncertainty about future trading relations between US and China that were not clarified last week as expected, as well as due to supply pressure. Container shipping rates slipped more because of slowing down activity ahead of Golden Week holidays in China. Bulk shipping activity intensified mostly due to positive developments in Capesize and Panamax segments. So, let's see what is next around the corner. But it will be already next week. Thank you for watching. Please subscribe to the channel, put like to this video, push the bell in order not to miss any updates, and see you soon.